Assalamualaikum warahmatullahi wabarakatuh. So our group have created two company which is Rocket Berhad and Rex Berhad. So for Rocket Berhad, it is founded in 1964. It is a leading Malaysian property corporation with a diverse portfolio in property investment, management, hotel operations, property development, construction, and REIT management. Rocket Berhad develops and sells residential and commercial properties, including office suites, shop lots, condominiums, and bungalows. It also owns shopping malls, engaged in retail operation, and provide utilities and ICT service. Dedicated to sustainable development, Rocket Berhad builds environmentally friendly properties that benefit communities. The company operates in Malaysia, Asia, Australia, and the US, and Europe.
Hello, my name is Nurania Erdina binti Shazim. My ID is MDA2207065. I will explain about Company A, which is Rocket Berhad, which they acquired land costing $5,500,000 on 1st January 2015. The useful life is 10 years, which the cost that incurred is the first one is purchase price 5 million, the second one is preparing sites for 100,000, the third one is administrative cost 12,200. After the company calculate the capitalized and expense of, there is two particulars of journal entry, which is the first one is PPE in the debit side, which is 5,400,000, and the credit side is cash or bank, which is 5,400,000 also. Okay, next is the debit is softball, which is 12,200, and the credit is cash or the credit side is cash or bank, also 12,200. That Rocket Berhad purchased a warehouse costing RM7,900,000 on 1st April 2022, and the useful life is 20 years, which the cost that incurred is contractors' cost, material, labor, technical overhead, and administrative overhead. However, due to cost efficiencies in direct material and labor, respectively, RM400,000 and 1 million were incurred. After calculating the journal entries, the first journal entries is debit PPE, which is 790,000, and the credit is cash or bank, which is 790,000 also. And the second journal entries is the debit side is softball, and the credit side cash or bank, amounting 1,600,000. Next, on 1st January 2015, Rocket Berhad acquired land costing RM5,500,000. The useful life is 10 years. The fair value of a land, which is 2016, 2017, 2018, 2019, and 2020, was revalued to RM6,500,000, 6 million, 7 million, 7,500,000, and 8 million. The journal entry that exists after we calculate is there is 6 journal entries that exist. On 1st January 2015, the debit is land and the credit is cash or bank, amounting 5,500,000. And on 1st January 2016, the debit is land and the credit is ARR, which is 1 million. And the third one is 1st January 2017, the credit is ARR, the credit is land, which is 500,000. And on 1st January 2018, the debit is land and the credit is ARR, which is 1 million. And 1st January 2019, the credit is land and the credit is ARR, which is 500,000. And the last one is 1st January 2020, the debit is land and the credit is ARR, amounting 500,000. And the second one is Rocket Berhad purchased warehouse, which the journal entries that incurred is the first one is the debit side is warehouse and the credit side is cash or bank, which is 7,900,000. The second one is the same until the last date, which is the debit side is depreciation and the credit side is accumulated depreciation, amounting 3,6,500, 3,9,500. It's also the amount is same until the last date, which is 3,395,000.
So, from the calculation of PPE and the journal entry for 2016, there is changes in fair value of 5,500,000 are charged to profit or loss as fair value gain. As for 2017, there is 1 million ringgit are charged to profit or loss as fair value loss, while for 2018 there are changes in fair value of 500,000 are charged to profit or loss as fair value gain. For 2019, there are changes in fair value of 1 million are charged to profit or loss as fair value gain. And lastly, for 2020, there are changes in fair value of 500,000 are charged to profit or loss as fair value gain.
Okay, so next I will explain about investment property, which for its company A, Rocket Berhad. So for Rocket Berhad, it purchased the investment property at an acquired date, which is 1 January 2020, which purchased a warehouse and also a land. So for warehouse, we use purchase investment property method. So the total cost for the warehouse is 690,000. And for the allocated to property, plant and equipment, we use 20%. And for allocated investment property, 80%. So for the recognition criteria for a warehouse is transaction costs, which include taxes and legal fees, have been consistently assessed and recorded at RM 40,000. The acquisition price and directly relevant costs make up the RM 650,000 total initial cost recognition. So for land, we use That's all for initial measurement. Now let's move to subsequent measurement, which we choose is warehouse. And we use the fair value method. So the Rocket Berhad acquired an investment property at cost of RM 690,000 of a warehouse. And the company closes its account every 31 December. So they have sold for administrative. And the useful life of this property is 10 years. So the fair value year is 2021, 2022, 2023, 2024, and 2025. This is the journal entry for subsequent measurement. And you can see the investment property, plant and equipment costs 700,000, 1,300. And so the accounting treatment for this property is reclassified from IP to PPE, and the deemed cost of PPE is to be valued at a carrying value of 1,300 on 1 January 2024. It's continue to account for the property using MFRS 110 PPE using the revaluation model, and the depreciation from the useful life, which is 10 years, is RM 70,130 is charged as an expense in profit or loss.
So, for the Rex Berhad, it is established in 1969. It's a leading Malaysian palm oil producer. It operates in plantation, refining and manufacturing of oleochemicals, specialty oils and fats, with a presence in Malaysia, Indonesia, Asia, Europe and the US. So, Rex plantation cover about 207,129 hectares, producing palm oils for food, commercial and industry. Committed to sustainability, Rex co-founded the Roundtable on Sustainable Palm Oil (RSPO) and aims for net zero carbon emission by 2040. The company follows strict environmental and social government guidelines, improving its sustainability practice despite past criticism.
Hi, my name is Diana Hazwani binti Dahlan, ID number MDA2207054. So, under MFRS 116, Company B, which is Rex Berhad, has their property, land and equipment. Rex Berhad purchased land and building at the cost of RM 1 million on 1st January 2017 with useful life of 10 years. The purchase price of the land is 1 million and will be undercapitalized, and the general administrative RM 15,000 will be expensed off. The total initial cost of land of the purchase price will be transferred to this journal entry. Same goes another PPE, which is motor vehicles. The total of initial cost of motor vehicles will be transferred to journal entry. Under MFRS 116, Company B, which is Rex Berhad, has their property, plant and equipment PPE, which is land costing RM 1 million. The fair value of land for 2017, 2018, 2019, 2020 and 2021 was revalued to RM 1.5 million, 1.1 million, 2 million, 3 million and 2.5 million respectively. As you can see, this is the revaluation model journal entry for company Red Berhad for property, plant and equipment on 1st January 2017. Company B revalued its land upwards from 1 million to RM 1.5 million. Next, Red Berhad also has another PPE which is motor vehicles. On 1st June 2018, Red Berhad acquired motor vehicle at a cost of 850,000. The machine is depreciated on a straight line basis over 10 years. The company implement cost model for the calculation of the PPE. So, this is journal entry for building cost model of company Red Berhad. On 2018 to 2022, depreciation of 85,000 is charged as an expense in profit or loss.
For the accounting treatment for Rex Berhad, for 2017, there are changes in fair value of 500,000 are charged to profit or loss as fair value gain. While 2018, there are changes in fair value of 400,000 are charged to profit or loss as fair value loss. For 2019, there are changes in fair value of 900,000 are charged to profit or loss as fair value gain. And lastly, for 2020, there are changes in fair value of 1 million ringgit are charged to profit or loss as fair value loss.
So for company B, which is Rex Berhad has their investment property, which is warehouse and land. For warehouse, the company used purchase investment property method. The purchase price was 700,000 with legal and agency fees for 30,000. The total cost is allocated to PPE for 20% and allocated to IP for 80%. As you can see, this is the journal entry for warehouse. The debit side was land and the credit side was bank. The second is land, which is the company used self-constructed investment property method. The total cost incurred was RM 52,500 and the cost of investment property was 136,489. As you can see, this is the subsequent adjustment for warehouse. The company used fair value method. Red Berhad acquired an investment property at the cost of RM 730,000. The useful life of property was 10 years. The business closed their account on 31st December for each year. The warehouse will be used for administrative purpose as 1st January 2025. The business used fair value model to account for its investment property. The fair value of a warehouse for year 2021, 2022, 2023, 2024, 2025 was revalued to RM 744,500, 731,500, 749,960, 737,070, and lastly is 800,000. As you can see, this is the journal entry for the fair value of warehouse. For the accounting treatment, the property is reclassified from IP to PPE. The cost of PPE is to be valued at a carrying value of 800 ringgit on 1st January of 2024. They continue to account for the property using MFRS 110 PPE using the revalued method. The depreciation of RM 80,000 is charged as an expense in profit or loss.